Okay. All right. So I'm Erin Gibbs from Main Street Asset Management, and I'm going to talk a little bit about how to manage both bond and equity markets in inflationary periods, since that is obviously the key. Just a quick background on Main Street Asset Management. We have 25 million under management. We do a top-down, bottom-up investment approach. So we have both an RIA with asset allocation as well as a hedge fund. I have about 25 years experience managing money. I was this equity CIO at S&P for about 15 years. And at that point was managing about 16 billion. So lots of experience on both the equities and fixed income side. And I wanted to just really get in depth about inflation, since I know everybody's been hearing the headlines of certainly what's been going on for particularly in 2022 with the past 6 months, but really help people understand. We use all of these indicators. So what do the indicators mean? And then how can you trade them in the different types of markets? So just a quick recap for people. The CPI is the most popular one. It's the one that we all have to talk about on TV. We have to report on. So, and that actually, it measures inflation by consumers. The great thing about the CPI, though there are some critics of how it's calculated, it comes out very quickly. It comes out usually about sort of the 10th day after the end of the month. So you get a reading rather rapidly. The same with the PPI and the producer side. So those are sort of the indicators that get the most headlines because they are calculated relatively quickly, and you get a good sense of where the market is. You're not waiting 2 months as many economic indicators are. The PPI is producer prices, formerly wholesale. There are lots of versions when you go back historically of different PPIs. The Bureau of Labor Statistics has changed their calculations, and they keep changing it. But this has become less and less important because now about manufacturing is about 11% of the US economy. So though this was a much more important indicator for businesses, particularly when it comes to the bond and equity market these days, it's less and less important as we become more of a service industry. The employment cost index, another one measuring inflation in the labor market. Obviously, GDP, gross domestic product deflator, that measures not only consumer inflation but also inflation as measured by from the government and other institutions. So it's another one that sometimes the Federal Reserve will measure or mention. And then the consumer expenditure surveys, which includes the PCE, the personal consumption or expenditure. This is the Federal Reserve's personal favorite. Again, measuring what consumers are spending among food, housing, healthcare, income. Now, though the Fed loves the PCE, the problem is it takes 3 weeks to calculate. So the PCE essentially comes out 2 weeks after the CPI, and typically it comes out after the Federal Reserve meeting because the Federal Reserve meetings tend to be in the middle of the month, just like this week. So just like in this month of July, we have the consumer price index that came out last week. The PCE isn't coming out until next week, and they've got their meeting this week. And so ultimately, though the Fed complains about the CPI, they do have to pay attention to it just because it's the latest piece of data. So just getting into all the measurements in detail so you understand what's going on and what to look at, because there are just so many out there when you really start looking at these in depth. And obviously the CPI, it has many major categories, over 200 actually, a couple dozen that are the major categories. But the CPI all items is the one that you see in the headlines. And again, just like the producer price, it's measured about the sort of on the manufacturing side, and again more on the manufacturing. And so you just have these consumer versus seller perspectives, the people who sell goods and versus people who are buying goods. And obviously right now we're really focused on both, and the PPI is an indication of sort of what the goods, what the inflation is going to be coming once it hits the consumer side. And so it's still important, but certainly as it now includes services, and they only recently added services a few years ago, but now still much more volatile and only just a small portion overall of what actually goes into the CPI. So here we are, just what it's been since 1951. And so right now, when the CPI comes out, you hear a lot about it hitting, highs, not seeing the 70s. And obviously, yes, that's exactly it. So sort of when we crossed the 6% mark, that was when we broke above the inflation from the 80s. We broke above, from the early aughts. We broke above inflation from the late 80s, early 90s, and now we're in inflation that we haven't seen since the 70s. So obviously, when you're looking at this from an investing standpoint, this makes it very challenging because the investment world of the early, from basically all of the 70s up until 1980 was very different. Lots of instruments we have now weren't available. Lots of measurements we use now within equities and bonds weren't available. So there's certainly a fair amount of guesswork when it comes to what can I use now that just simply wasn't in existence back then. And also our Federal Reserve is very different. Our Federal Reserve these days meets every single month or 10 out of the 12 months versus quarter. So it's a much faster paced market. Things can change. And again, it makes a difference on how you invest. But so, people talk about the 70s, but you can't necessarily use what worked in the 70s in today's market, because obviously in 50 years, both the bond and the equity market has changed quite a bit. And here, just to give you an idea of that, the PPI, the orange PPI since the 50s, this is their oldest one. It's just for finished goods. The blue one now is the one that's reported. This includes services. So this is the one that's reported. And like I said, there's not a lot of history, but you can see that they track very closely. And you can also see that it's certainly more volatile than the CPI. In fact, the PPI was 11%, so a little higher than the CPI. So important for the manufacturing side, important for what sellers are facing and how much that's going to be potentially hit by the consumer, but certainly less important from an investing standpoint. And just here they are compared side by sides. The orange is PPI, blue CPI. So you can see you just get bigger swings, much bigger swings in that PPI versus CPI. And tends to be somewhat of a leading indicator. So now getting into how the bond markets react to inflation. So here we have the CPI. Here's the 10-year. Now, obviously, they are correlated, and this is why I'm bringing it up, because it is the two are heavily correlated. You obviously get much bigger swings in the Treasury yield versus the CPI, but or at least historically you did. But now you still see that the 10-year still is in this very long-term downtrend and only just starting to come back up, while the CPI is already well ahead of the curve. But in general, you can see that often, before in the 70s, the 10-year really lagged the CPI. So the CPI peaked, the 10-year kept rising, even though the CPI was coming down. And in general, there's a correlation. There's definitely a bit of a lag. These days, really, the 10-year tends to actually change a little beforehand, and often is a leading indicator in trends, or simply, as you can see, it kept going down even when there was quite a bit of fluctuation. So a little more stable. So though they're correlated, it's certainly not a perfect correlation. And so one of the instruments that we can use that I want to talk about quite a bit when coming to protecting against inflation is your TIPS, Treasury Inflation Security Protection Securities. Now, these TIPS, they're treasuries that are tied to the CPI. So again, even though the Federal Reserve likes to mention the PCE, the actual Treasury yields are actually tied to the CPI. And the Treasury pays an adjusted principal on the maturity date according to the CPI. And so this instrument only became available in 2003. And so that's when I talk about strategies and what you could do when we were hitting this really high inflation back in the 70s. We have less than 20 years of this instrument even being available to us. So it's challenging to figure out how it reacts and how to use it, since we really haven't had extreme inflation when these instruments were starting to be issued by the U.S. government. In fact, some of them weren't even issued until 2010, so we just have 12 years of history to work with. But it's certainly important because this is it tells you how much people are willing to pay for inflation protection. It gives you a good sense of how much inflation is being anticipated by investors. And it also gives you an opportunity between using the traditional treasuries as well as the inflation protected securities and being able to move between the two types of instruments to help preserve capital or perhaps even improve pricing. So to give you a sense of how these track with each other, here's the 5-year treasury, the yield of the 5-year treasury, and then the yield of the 5-year inflation index. And so you see they don't move in tandem all the time. They're not perfectly correlated. Obviously, that inflation protection is there. There can be some wacky instances. Here we have a financial crisis where the yield of the inflation protection was actually higher than the Treasury yield significantly. That's the only time it's happened in its history. But there are periods where you can see that treasuries are going up, indicating they expect higher interest rates, yet the inflation and protected yields are staying flat. And that actually happened quite recently here. So the yield of the 5-year was going up since early 2020. Yet the yield of the inflation protection didn't go up until December of 21. So even though we saw increased inflation numbers and saw increased CPIs, this was a great way if you want to protect on pricing, because obviously yields going up means that prices were going down. So here the 5-year price is going down as yields going up, whereas you had an entire year of price protection and stabilization within TIPS, within the early stages of inflation. Now, finally, after December, even the TIPS start catching up, the price declines severely and a much more dramatic speed than in the Treasury. So this is the point where you might want to switch to a Treasury versus that inflation protection. So sort of, when everybody finally gets the picture and finally gets the memo that inflation's going up, that's when the TIPS, the yields go up, the prices go down, and treasuries in relation are more attractive. And similar on the other side, again, the bond market, the regular standard treasuries tend to be ahead of the curve, and the inflation protection behind the curve. And so when we see a deceleration, again, your treasuries are probably the ones, if you see their rates going down, prices going up, it's more likely to happen in your treasuries before it's going to happen in your inflation protection. And so here we have a similar relationship in the 10-year, not quite as dramatic with changes, because obviously we don't have the yields in the longer terms move quite as much as the shorter terms. But here we have these periods where inflation protection in the early aughts, where actually the yields were going down while the yields in the treasuries were going up. So here this means that ultimately prices are going down, and here prices are going up. So just when we do get these movements in inflation, there's actually a lot of opportunity in being able to switch between these two. And once more, again, in the 20-year, even more behind the curve. And in fact, the inflation protection on the 20-year kept declining right up until about March. So if you were in a long duration inflation protection, your prices were very stable, not until March, and that's when the yields finally shot up and rocketed up. Definitely early stages of inflation, this is sort of the laggard, and that's where you want to be. You do not want to be in it at the end of sort of the inflationary cycle, and maybe switching over into the standard treasuries. And so here just some of the changes in yield. So here on the 5-year, we had a 3% move between the two. We had about a 2% move between the 20-year. And here's, just to give you an idea, so these inflation protection treasuries didn't start changing up until February, March for the 20-year, not until December here, and even in the 5-year. Yet, when you look at the CPI report, I mean, there was a clear indication that we were facing inflation. And I know in the headlines, everybody was saying it's transitory, but nonetheless, and we did have a couple dips in mid-2001, but nonetheless, when you start crossing above that 4% line, hitting 5%, these were the times that there's definitely, 5-6 months of a clear upward trend. Even in October, the 20-year still wasn't reacting, and plenty of time, several months of opportunity before really the entire inflation protection bond market started reacting. And this is just to give you an idea of a strategy that we use. We use the tips in fourth quarter and the very beginning of first quarter of this year. But the spreads between the 5-year treasury yields and the 5-year inflation index, basically the 5-year, you had an 8% price decline if you bought in May. So, still 2 months after the CPI report is coming up, and sold in March 22. That's, like I said, when the message got out across the board and all the yields are jumping up. So you would have gotten a 6.3 improved price performance if you had been in an inflation index for this period. On the 10-year, about a 9% improved price performance mid-2, because the 10-year dropped 8% and the 10-year inflation index only dropped about 1% in price. Very little change in the yield. And then in the 20-year, you actually had a price increase. And this is how I'm saying this is how delayed reaction these longer duration bonds have. You get a 10% decrease in your 20-year treasury yield over this 10-month period. But yet the inflation index actually had a 7.6 price increase, so a 15% spread. And so, obviously this is in the past, and this is when inflation is increasing, but this is something to keep in mind of, and keep in mind when eventually, the inflation starts dropping. And yeah, we certainly haven't seen it yet. We hit another record back in June. But if we're taking a look at commodity prices and some indicators and increasing openings, probably very likely I'll be able to flip these examples and sort of buying your treasury yields, shorting your inflation index, and the relative performance is going to be the opposite because of this lag between the two types of instruments. So in summary, during increased inflation, all durations offer better price protection. The long terms, absolutely, you get the best price performance, but you do want to be careful about getting in because the convexity, obviously the price changes a lot more with longer terms. Medium term tips, are sort of that middle of the road, nice entry points, but still a lot of profitability. So these are the easiest to trade. And again, short-term tips, you obviously move much more quickly. You don't get as much volatility in the prices, but they're going to be the ones that change the fastest. So only at the very beginning of these changes, for early inflation signals or early deflation signals or a deceleration. And so though obviously trading the actual instruments can be rather difficult, there are ETFs out there so you can, basically leverage these strategies much like you can leverage any equity. So short duration tips, if you're not familiar with these, iShares has 0 to 5-year tips, so great at the very early stages of changes. Vanguard short-term inflation protection has a basket of inflation protection. So these are all the 0 to 5. Nobody really does a pure long-term where they're talking about 20 years plus. But there are some medium terms where they use a mix of 5 and 20 years in their portfolios. And so Goldman Sachs inflation protection is medium term, TIPS bond ETF is medium, Schwab. So you can use these depending where you are in the cycle, but using the CPI, using the PPI, and then understanding how to leverage these against your treasuries is a great way to either preserve your capital or even actually get some real price appreciation. As when we have these dramatic changes in interest rates, these prices of these bonds move quite a bit and make a big difference. So that's sort of the summary on how you protect from on the bond side, because they're the most correlated. But on the equity side, certainly we want to see what goes on within the stock market, because it's still, though there are a lot of things that affect the stock market, certainly it's another important indicator. From the full history from 1951 to 2022, we've had quite a few inflationary periods. But when you look at just what you can measure within major indices, really, though the S&P 500 goes back just as far, if you start looking at investable ETFs, sectors tracking growth value, you really only have history from about the mid 80s. So if we're looking at what can we really analyze from a practical standpoint, looking at different sectors, different styles, here are the periods that we want to focus on. These are our inflation periods. Now I know, again, nothing is like what we had in the 70s, but still we can use what we have to try to at least be a little more informed about how inflation can affect performance. So I use the S&P 500 in these exhibits, and then the GIC sectors within the S&P 500. So obviously it's the 500 largest companies that approximate about 80% of the US public market. And it's also just, one of the most widely used for ETFs. So very easy to trade, very different options within the S&P 500. So during those inflationary periods, so there are 7 of them that I've identified where basically inflation goes over, so CPI goes over 3% and is basically increasing or tends to be in an increasing trend. And so during those 7 periods, still most of the time the market had positive returns, so a little over half the time, 55 versus negative. So this ratio of positive and negative monthly returns is definitely worse than non-inflationary periods. We definitely have more downturns during inflationary periods. And we're in, let's say, as I've identified in inflationary periods, about 1/3 of the time. So I'm talking about 1/3 of the time we have inflation over 3%, and it's an inward upwardly increasing trend. And we've definitely still have most of the time we have positive returns, but we've also got some negative here. And just on a very quick sort of summary, I wanted to see, is there a really obvious outperformance of growth versus value? Because that's sort of, one of the historical, or I guess, one of the things that people say is, oh, value outperforms during inflationary periods. And actually, that's not true. In fact, it's really 50-50 when you look at purely CPI periods. So it's not that in any of these blue boxes that we see that all the bars are on the value side. So like up, it means that value is outperforming, down means that, other way around. Up means gross outperformance, down means value is outperforming. And so we see that it really flip-flops during this period. Yes, here and here in the early aughts, in the 2004, 2005, value was outperforming, but here growth outperforms. And for the first half of this inflationary period, growth was really outperforming. So if you're trying to just say, oh, I'll just go value or growth as soon as inflation works, it's a 50-50 shot. It's not something that's necessarily going to work. And so we need to dive a little deeper. So then just diving, further into it and looking sector by sector, I have these 7 periods and then the performance by sector. And I know this chart looks messy, and that's sort of the point is, once again, there's no one sector that is outperforming every single time. Certainly energy, this yellow one, has been a big winner for a couple of them, but it's by no means guaranteed. It underperformed in several other periods. And so really the only sector that is a little more consistent about outperforming is real estate, but real estate has only been a separate sector since about 2006. We don't have a lot of history, but that's one area. But once again, there's no clear outright winner. If anybody says you should be in financials during inflationary periods, that's not correct by any means. In fact, there are many times when financials have underperformed, including this latest one. So once again, it's about understanding the full market picture, sentiment, where you are in the inflationary cycle. And here we have the relative performance for these inflationary periods. And so, yeah, if you sum them all up over the past the past 35 years, energy has been an outperformer, but it's largely because of sort of 3 distinct periods. Healthcare has been an outperformer, but again, it's sort of that's hidden because it really came from one period. So the only thing you can really say is that communication services actually was consistently an underperformer. So at the very least, I can say don't get in communications during periods of inflation. That is one big consistent loser. And here we have the percents of months when you're outperforming or underperforming. So green is the number of months when you're outperforming, red's the number of months where you're underperforming. So, ideally you'd love to see something that has like either no green, no green or all red and no green, and know that that's a sure thing, but nothing in the equity market is. So as you can see with most sectors, it's sort of 50-50. Half the months they're outperforming, half the months they're underperforming. And the only clear winners, again, communication services, you're losing significantly more, or about 10% more at a time than you're winning. So that's one that you at least can avoid. And then again, like I said, real estate, since real estate has been and more recently become a sector, that's one where it more consistently outperforms month over month, and then a little bit of a bias in energy. So no big signals, no clear trends where you're always winning or losing. Just you may want to avoid communications and use real estate in inflationary periods, but nothing's like an absolute winner. And here we have that spread between the number of months that you're outperforming versus the number of months you're underperforming, and your median return. So again, the ones that have the bars that are like heading in the same direction a little more clearly, communication services, real estate, and a little bit of energy are sort of like your more safe spots if you're looking at sectors. And so it really comes down to where have you been not only just looking at styles and sectors, but understanding where you are within the inflationary process. Energy is still a very volatile market, so it's still very much about oil prices. And are those oil prices going up? Because you can have inflation without oil necessarily increasing and profits increasing. So you still need to be looking at fundamentals. And the only takeaways that you can really do are communication services, consumer discretionary materials, at least are the ones that you want to be underweighted. And they're pretty consistently the underperformers of those periods. But you can still have obviously winners within those sectors. They're just going to be harder to have winners during periods of inflation. And if now I just sort of graphed just to give you an idea of each of these inflationary periods, I would say the one that probably is the most like what we're going through now, where we're in definitely a bear market, is the financial crisis. So there was an inflation period during the financial crisis, so September 7th to 08. So brief. But you can see staples and energy, at least on a relative basis, were some of the winners. They lost less. And financials were, of course, it was a financial crisis, so that has less to do with inflation and just what was going on with the debt market. But still, communications and consumer discretionary were also some of the worst hit. So just again, helping you understand and learn from all these different periods exactly what was going on. And this is our sector performance since this current inflationary period. So here, energy, obviously a big winner, but that looks to, that's slowed down. It looks like that play is sort of done as oil prices are coming down. We've utilities, healthcare, consumer staples, still have positive returns. They basically haven't declined as much in 2022. Real estate as well has held up a little better. But again, discretionary and services, definitely the ones that you've wanted to be out of for this particular run. Both when the market was doing well in last year in 21, as well as the past 6 months. So, like I said, there's, only is so much you can do when purely looking at inflation across different sectors or different styles. And I wanted to focus a little about when you're in a bear market and you have an inflationary period, what are some of the safety spots? And another sort of, old school or old rule is to look for high paying dividend stocks when there's inflation. Move away from growth, look at your dividend payers. And so here, I just wanted to show, overall, there are a couple indices, the dividend aristocrats and the high dividend index and the S&P 500. So these, again, are easy index where there are a bunch of ETFs that follow them, so you can use them. And when you look at in the up markets, they definitely underperform. So these are not the type of tools that you want to use when the market is up. However, they do offer protection. We've got aristocrats, the median return is less. Same with the high dividend is significantly less than the S&P 500. So certainly, if the market's down and we're in an inflationary period, these types of stocks, so high-paying stocks, do look more attractive. The difference between the dividend aristocrats and high dividend yield, aristocrats have to have 20 years of growing their dividends. So they really have to be high quality, where they're constantly increasing their dividends. High dividend index just means it has the highest dividend currently. So it just depends on whether you want to look for like sort of ultimate safety or just who's going to give you the most income right now. And there are some studies, and this is sort of a newer area to look at. But when looking at the difference between the high payers and the stable dividends, when there's a lot of volatility, you see outperformance. So basically when the VIX is moving above the 10%, every single period, the dividend aristocrats actually gives you a higher return than just the high dividend yield. So when you're in these bear markets, when you've got a lot of high volatility, and we haven't seen the VIX go below 20 in almost 6 months. So this is that period. And the only time that these dividend aristocrats underperform are when the VIX is moving, basically when it's in when the percent change is less than 0, so just or the monthly increase. So when the VIX is going down, so when the VIX is calming down, basically when the VIX is sort of in the 0 to 15 range. So when volatility is coming down, when things are calm, we're back in an upward market, that's when these dividend aristocrats underperform. And that's why you see this underperformance in up markets. But when we have a lot of volatility, the VIX is moving, and it has been moving. We've seen these sharp swings all year long, both for up days and down days. And these are the periods where you do see outperformance and some safety. Though not, perfectly, still have, negative returns in many cases, but certainly significantly more protected if you are exposed to equities versus being in all cash. So let's just, for me, it's another area of research to dive even further into looking at all of these opportunities. But again, these have only been around, these types of instruments, these indices have only been around for about 23 years. So we don't have that type of research where I can look back in the 70s, but since particularly this period and looking just at what's happening this year, definitely it looks like an opportunity for capital preservation. And that's the end of it. I appreciate you having to watch my slideshow without the full slideshow, but seeing it in my PowerPoint format. My apologies for technical difficulties, but there you go. So that's just what we're covering. I'm Erin Gibbs, and so there's some ideas on how we're going to manage this, and hopefully how we're going to manage it on the other side as inflation starts slowing down.